Hello everyone, Clifford Bennett, Chief Economist, ACY Securities, and exactly as expected, and the pressure really was on for a rate hike yesterday, which is why they've given the indication that there will be another rate hike this year, which flies in the face of all those interest rate cut expectations. Now, while the dot plot says maybe in 2024 there could be one or two rate cuts, remember, that's just what the FOMC members are thinking now. It isn't what they're going to do. And the dot plot rarely represents what they end up doing. So there's way too much emphasis put on the dot plot. So I still don't think there's going to be any rate cuts next year.
Hi traders, and thanks for watching. We'd like to take this opportunity to thank our incredible viewers for tuning into our channel. We would greatly appreciate it if you could hit that subscribe button, as we're pushing for the 10,000 subscriber mark by the end of the year. Now back to the video.
Because inflation's going to remain firm as unfortunately geopolitical conflicts continue and keep energy prices high. There's not going to be the room to cut. However, there could be if the US economy falls off a cliff, as I think it may well do, as the whole environment there really has significant underlying fundamental problems. And, you know, with these higher energy prices, with stabilization of manufacturing at a depressed level, with GFC-style consumer confidence levels, it's not a pretty picture when you have the Federal Reserve still keeping rates high and indicating they will hike rates further. For all we know, there could be another 1 to 2 rate hikes in 2024, not cuts. So don't put too much emphasis on the dot plot. It isn't what will happen. Okay, it's their current thinking now, given current circumstances and their current expectations, which is that inflation will cease to be a problem. They're not going to cut rates unless inflation ceases to be a problem. And inflation at the moment is reaccelerating. I think the Fed is probably going to raise rates at the next meeting. And of course, all of this is reflected in the price action. Remember, I said there could be a momentary rally on the back of no change in rates, but then it would only last 3 to 12 hours, I said on national television yesterday, and then 3 to 24 or 18, something like that, I said. And then I expected markets to begin to fall again, and I myself would be a fresh seller, which I have been. So the price action is diabolical, can I just say? Because remember, we used to be in an environment where the Federal Reserve would raise interest rates and the stock market would rally. What happened today? The Federal Reserve kept rates unchanged and the stock market had a sharp down day. All the good news, which wasn't good news, it was false hopes. All the false hopes for the bulls are now being eaten away very quickly by the reality of the economic data that's coming in. And, you know, people who traded long just on the basis of a pivot, they completely have to get out of those positions now. I did say on Saturday that Friday's price action was looking like and indicating that the big, large money funds were beginning to lighten their equity holdings. And I think that that price action yesterday on the FOMC confirms that view. And I can't make the point more significantly than to repeat it again. We used to have Fed rate hikes and the equity market rallied. We now have no rate hikes and the equity market falls sharply. What does that tell us about the positioning in the market? Way too invested, way too long, and the big money funds are beginning to get out of the stock market. Now, they're not going to get fully out, but they're trimming. They're trimming and trimming and trimming. And that can snowball into something very significant, perhaps even a sustained bear market from here. So a lot of people will be looking to buy the dip today, and that could hold the market a little bit, but I think the interest in selling is only going to grow over coming days. At best, there will be a small bounce or a reasonable bounce in the US market for Friday, but come next week, if not immediately tonight, come next week, I think you're going to see an increasing wave of very significant institutional selling. And remember, our opportunity as individual traders and investors is to get ahead of the big organizations which need committee meetings to change their portfolio settings and their trading and investment positions. Whereas we can act quickly and we're getting the same information, but we have a lot more flexibility because we're smaller, we can move faster, and because we're not trading by committee, thank goodness, because as John Maynard Keynes, famous economist, said, trading by committee is a sure path to failure, which is why the big funds underperform so consistently. So I do emphasize this could be the start of a major bear market. Well, actually, it started a few weeks ago, and you'll know that I've been warning of this for the last few weeks, and I was bearish near the recent top, but I was also bearish before the recent top. But I do think the market is beginning to unravel now in a price action manner that fits with the underlying fundamental reality on the ground, which is that in history, never before have we had a weakening economy with high inflation that forced the central bank to keep raising interest rates despite and even desiring that very same economic slowdown. These are historically unprecedented times, and I think the equity market is more than fully priced and has a great deal of vulnerability to the downside, which represents tremendous opportunity to individual traders and investors. So keep an eye on this price action. I have a feeling there's not going to be any bounce at all this Friday in New York. There could be. I have a feeling there won't be, but whether there is or isn't, I think next week could be a very bearish market for US equities in particular. I hope this helps. Have a great day. Have a great weekend ahead. I won't be reporting tomorrow. All the best for the weekend ahead. Clifford Bennett, Chief Economist, ACY Securities.